Dude, I'm so excited to share with you 5 dividend stocks that I'm buying and holding forever. Hey, what's up? I'm Russ. Thanks for stopping by the channel and making me a part of your investing journey. I'm super excited to share with you 5 dividend growth stocks that I am currently buying and holding forever, with the caveat, of course, that their core fundamentals aren't faltering or changing, or my thesis for buying has not changed as well. And like all things in life, when the facts change, we can't be stubborn and we have to be willing to change our opinions with the fact. Now, these stocks are not junk, but if you're looking to buy and sell junk, be sure to contact this video's not sponsor, Sanford & Son Salvage at 9114 South Central Avenue in Los Angeles, and be sure to tell them Aunt Esther sent you.
You big dummy!
In no particular order, let's look at 5 dividend growth companies I'm currently buying and holding forever. First up is PepsiCo. If you follow me, you know that I love PepsiCo, and I have been buying, true to my word, 1 share of Pepsi a week for 100 weeks is my goal. I just hit 75. So 75 shares of Pepsi for 75 weeks. It's been kind of crazy. I've learned a lot. When I hit that 100, I'll make a video on everything I've learned. Pepsi was incorporated in 1919. They're present in over 200 countries, and they are a global food and beverage powerhouse that wants to create more smiles with every sip and every bite. They are organized into 7 segments, which is what I love about them. Frito-Lay North America, Quaker Foods North America, PepsiCo Beverages North America, Latin America, Europe, Africa, Middle East and South Asia, or AMESIA, and the Asia Pacific, Australia, New Zealand, and China region, or the APAC. And check this out, most people think of Pepsi as a soda company, but not so. In 2020, 55% of their revenue came from food, and 58% was from the US, with 42% outside the US. So they are truly an international company that has properties all over the globe, from Plano, Texas, to Vallejo, Mexico, to Kashira, Russia, Levaheim, Israel, and Wuhan, China. They also have many joint ventures with some of the more notable companies that they distribute and they market and they bottle for our Keurig Dr. Pepper, Unilever, Starbucks, Dole, and Bang Energy Drink. Now, they also had Rockstar that they were a partner with until they purchased them in March of 2020 for $3.9 billion. And amidst the pandemic of 2020, they also started really innovatively direct-to-consumer sites, snacks.com and pantryshop.com, where you can buy directly from PepsiCo. Interestingly, in their last 10K, they said that the highest food and beverage sales are in the third quarter and the lowest are in the first quarter of the fiscal year. But overall, as a whole, it doesn't affect their net consolidated financial results. So this is kind of good and bad, but in 2020, their sales to Walmart and Sam's Club made up 14% of their net revenue. And of course, their primary competitor is Coca-Cola, and they are still a distant number 2 in the soft drink category. But what I love, and I always say this about companies, as we'll see, that they are a living, breathing entity, and an entity's first order of business is survival. So they're trying to adapt with the changing consumer trends for health and wellness, and they're spending research and development on reducing added sugars, sodium, and reducing saturated fat. I think this is really neat that in 2018 they bought SodaStream for $3.2 billion, and they have an initiative to go beyond the bottle, where they would like to have consumers basically create Pepsi from their house with the SodaStream by just adding the bubbles, as they say. Now, Pepsi has paid a consecutive dividend since 1965, and every year just up and to the right. They are almost a dividend king. So we love Pepsi for that growing dividend, of which it is currently $4.30 annually at a 2.62% yield that's paid out quarterly. Payout ratio is under 70%, good coverage ratio, and the 10-year growth rate, a very nice 7.8%. Now, earnings per share took a big drop from 2018 to 2019 because Pepsi spent a lot more money on growing the company. So they said there was going to be a drop off in earnings because they wanted to put more money into growing the company and making the company bigger. But still, a 6.9% annualized 5-year earnings growth rate. The sales up and to the right as well. 2.2% annualized 5-year growth rate. And again, cash flow with earnings took a hit from 18 to 19, but over the last 5 years, cash flow has grown 4.2%. I just love that Pepsi is so dominant in the salty snacks food category, and they are a force around the globe. They are in almost every country. They're a worldwide brand, and I love it. So yeah, they may be taking a backseat to Coke in the carbonated beverages category, but hey, you know, they can have that, but Pepsi is just going to keep growing. I love that they're innovating and trying to adapt and change with the times and growing by buying brands that are focused on healthier food and snacks as well. I love Pepsi. On to the next one, which is 3M, ticker MMM. Now, in my opinion, they are a global technology company that began operations way back in 1902. And they were incorporated in 1929. And they operate in 4 segments, which is healthcare, safety and industrial, transportation and electronics, and consumer, where you can see safety and industrial is by far the leader. That was good for 37% of their sales. And it was close. Healthcare and transportation are basically a tie, with the consumer products bringing up the rear, much like another company that we'll be getting to in just a minute. I really love this. Almost 50% of their income before taxes was from international sales. So really, this is why I say they are a global technology company that has 64 manufacturing facilities in 29 states, and internationally, they have 97 manufacturing and converting facilities in 35 countries. They spent the most they ever had on acquiring a company when they bought Acility in 2019 for $6.7 billion, which is a wound care company. So this shows me that 3M is also serious about shifting more into the healthcare field. I love companies that buy back stocks, and in 2020, they authorized $10 billion worth of share repurchases with no end date in sight for that, but I like that they are buying back shares consistently. 3M has paid dividends without interruption for over 100 years, and they have increased that dividend for 63 consecutive years. Much like Pepsi, just up and to the right with some massive increases, 35% to 2014, 20% to 2015. You get a 16% from 17 to 18, and it's tapered off a little bit, but just very healthy up and to the right. That dividend currently is $5.92 paid out quarterly for a 3.30% yield. Payout ratio under 60%, 57.28. Very nice dividend coverage ratio of 174%. And the 10-year dividend growth rate is sitting at a very, very stout 10.8%. 3M also took a bit of an earnings clip from 2018 to 2019 when they dropped 14%, but they were helped out by the pandemic with all those masks, and they rose 18%, 4% annualized 5-year growth rate. Revenue has been just about flat the last few years, but is expected to jump in 2021, only a 1.2% 5-year annualized growth rate. And again, cash flow dropped in 2019, but did increase with the pandemic. So the 5-year annualized cash flow growth rate is 3.1%. Something to keep an eye on with 3M. They're going to be okay, in my opinion, but their research and development is about 6% of net sales, and that really hasn't translated into additional sales growth, where it's kind of been flat as we saw, but they are slowly transitioning to service and address more of the global demand. So that's what I love to see, companies expanding outside of the United States and really growing that global reach. I love 3M, and they may be a little bit fairly valued to overvalued at the recording of this video, but with companies that are so strong and so solid and just about everywhere, I challenge you, when you go into a Home Depot, try not to see that 3M logo. I love 3M. I'm going to keep buying them. I'm really going to load up if they pull back to the 140s. And it's on to the next one, number 3, which is a sin stock and one that people love to hate, and it's been dumped upon and trashed, which is Altria, ticker MO. And yes, everybody thinks of them as cigarettes, but they're transitioning because they have a 10-year vision to responsibly lead the transition of adult smokers to a non-combustible future. And they're moving beyond smoking, which is leading the way in moving adult smokers away from cigarettes by taking action to transition millions to potentially less harmful choices. Again, what I said about entities trying to survive. They see the writing on the wall. They see the shift, the declining cigarette sales. They're going to do what they need to do to augment what they do to address that shifting consumer demand. And they are conceding that they want to move people away from cigarettes. And we see this with products such as the On nicotine pouches, the IQOS, and Marlboro heat sticks. And they have coming down the pike the 3rd generation of the IQOS. So they're clearly moving and trying to shift and meet the demand for non-combustibles, for products that heat and don't burn, because that is probably going to reduce some of the health risks that are associated with it'll be less risky is basically what they want their products to become. Altria owns Philip Morris USA, St. Michel Wine Estates, which produces 14 Hands. They also have a 10% stake currently in Anheuser-Busch. There's been some debate if they are going to get out of that position. They have a 45% stake in the Canadian cannabis company Cronos and that infamous 35% stake in Juul, of which they've already written down $11.2 billion of, and they cannot compete with Juul in the e-cigarette category until December 20th, 2024. Altria's 3 reportable segments are smokable products, oral tobacco products, and wine. And as you can see, the smokable products segment just dwarfs the other 2 segments. And at the recording of this video, we're still awaiting the FDA's ruling on the ban of importing the IQOS devices to market and sell here in the United States from Philip Morris International, because British American Tobacco, ticker BAT, filed copyright infringement or patent infringement lawsuits, and we'll see if that's going to be upheld. So in 2015, you can see how Altria has underperformed. If we would have put $100 into all 3 of these in December of 2020, your Altria would be worth $93 a share with dividends reinvested. The S&P 500 would be worth $202.98. But let's be honest, the reason we're buying Altria is for that dividend that keeps growing, and they know it, which is why they have increased that dividend 56 times in the past 52 years, which they always have a healthy raise. It's always around 8-9%. Some years it's 18%. But that dividend, of course, up and to the right, which is why we're buying Altria. That dividend's currently sitting at $3.60, which is good for an 8.29% dividend yield paid out quarterly, 90 cents every quarter. That payout ratio has jumped up, but keep in mind this is the earnings per share payout ratio. The free cash flow payout ratio is a bit lower. And you can see the dividend coverage ratio only at 43%. But they have a commitment to that dividend, and they have increased it at 8.8% of a 10-year compound annual growth rate. And it's not so odd, because as you look over here at all the other sin stocks, BTI is at 8.6%, Universal Corp 6.9, Philip Morris 5.3. They obviously took that big hit from 18 to 19, writing down $11.2 billion in Juul, so they dropped 117%, but they've obviously recovered a bit since then for a negative 2% annualized 5-year growth rate. So that's not very good and something to be concerned about. They have been about flat with these sales, and they're expected to drop in 2021 with a 5-year growth rate of only 0.6%. And the cash flow obviously took a hit as well, down 113%, but up 581%. Not hard to do when you're coming up from below zero, and the 5-year growth rate is down 2.8%. One of the big knocks against Altria is that they are a United States pure play company. So they don't have any international exposure, but they are biggest in the United States market. So they're basically, I think, kind of like a regulated utility. The government obviously has their eye on sin stocks like Altria, which is why they say they're committed to paying out 80% of their earnings in the form of a dividend. So they are very similar to a REIT. Remember, REITs have to pay out 90% of their earnings in the form of that dividend. So the regulation is always a risk. And we're going to see what happens with the FDA IQOS ruling, or as I call it, IQOS. And if they're allowed to bring that into the US market and distribute and sell the IQOS, then I think that's really going to give a nice boost to their earnings and to their growth. And if they're not, it's okay because they still have about 25% free cash flow margins. So I'm still buying Altria, but you do have to be concerned and know that it is probably the most risky stock on this list. But sometimes you have to risk for reward. I think it's a good calculated risk to take with Altria. So I'm going to keep adding sparingly to Altria while it's down at these levels. And I think it is a little bit undervalued. And remember the dividend. I always say it. The dividend can be taken away at any time. It's a privilege. It is not a right. It's not something that they have to pay out. It's kind of like when you got video game or TV time from your parents. That was not a right. It was a privilege, and they can revoke that at any time. But for the time being, I'm still buying Altria until some new facts change and changes my opinion. On to number 4. And as we say, what gives more raises than a cat house full of sailors on shore leave? It's Realty Income, who just merged with VEREIT and spun off VEREIT's and Realty Income's office properties in a separate entity called Orion Office Properties REIT, ticker ONL. And they raised their dividend because they are, as they put, the monthly dividend company. They are remained committed to operating their company in a manner that provides the shareholders with dependable monthly dividends that increase over time. And I absolutely love that they say the dividend is sacrosanct. If you haven't been on Realty Income's website, I highly recommend it. They have some fantastic information on there. So they are one of 65 companies in the Dividend Aristocrat Index. They are a top 10 global REIT. The dividend has compounded at 4.3% with 112 dividend increases. And where they're going, I love it. They want to become a $50 billion plus global company, a top 5 global REIT. They want to average double-digit total shareholder return. And again, that dividend is sacrosanct to their mission. I love looking for companies that have that commitment to the dividend as us being dividend growth investors. And Realty Income is one of the most dividend growth focused companies that is out there. Now, if you had put $100 into Realty Income at the New York Stock Exchange listing in 1994, at the end of 2020, that $100 with dividends reinvested would have grown to $3,331. I love this portfolio diversity. Over 7,000 properties under long-term net lease agreements, 650 different clients across 50 states, Puerto Rico, the UK, and Spain. Check out those top 20 clients. If you ever wanted to be a landlord of 7-Eleven or Walgreens or Dollar General, Realty Income is a really low bar to enter that. Really good diversification, convenience stores. I don't see Amazon putting convenience stores out of business anytime soon. And I love that 7.5% of the revenue is from dollar stores because as times get tougher, dollar stores, I believe, are really going to surge and grow. Check out the overlap of the top 20 tenants of Realty Income and the top 10 tenants of VEREIT. We see that half of VEREIT's top 10 overlap with Realty Income's top 20 with Dollar Tree Family Dollar, Dollar General, Walgreens, FedEx, and BJ's Wholesale. I love that they're trying to grow in Europe. They have a plan to be a global REIT one of the top 5 as we saw, and they have their foot in the door in Europe with Sainsbury's, B&Q, Tesco. The total addressable market of Europe is massive, and Realty Income wants a big chunk of that. Fantastic occupancy percentage in 2021. Look at those numbers. 98.8% occupancy out of 7,018 properties. Look from left to right how those numbers have grown. And there are only 86 vacancies, with 2020 pandemic year having 140, which was the most ever. And speaking of pandemic, are they pandemic proof? I would argue so, because their earnings per share grew 2.1% on top of 3.1% dividend growth when other companies were negative and cutting their dividend. This is why Realty Income is such a strong and well-run company. And this is one reason why you see that Realty Income is so highly regarded. They've had 113 dividend increases since 1994, 96 consecutive quarterly increases with an average CAGR of 4.5%. And over the last 52 years, they've paid over $8.4 billion in dividends, and they have had 0 dividend cuts. Not huge raises, so again, that dividend does increase. Nothing big and drastic, which is okay because they give increases every quarter, which is just phenomenal. And the current dividend is $2.95, again, paid out monthly, now 25 cents every single month per share. The payout ratio, pay no attention to that because this doesn't use AFFO, which we won't get into in this video. They are good, and they have a 10-year growth rate of 5% on that dividend. And you can see that yield is well above many of their industry peers. Like most companies, 2020 was a down year. They dropped 17% with a 5-year annualized growth rate of only 1.1%. That revenue has been increasing at double digits, because you can see their 5-year annualized growth rate is a very healthy 10%. And now while the cash flow has been about flat-ish, the 5-year annualized growth rate is also at a very nice 10%. And we see that the earnings and dividends, the AFFO per share and the dividend per share growth is just up and to the right since 1994. So they're a solid company, great management, love me some Realty Income. I love that they have big dreams, they have big aspirations to expand into Europe and really grow the company and grow that business for us, the shareholders. They're probably, at the time of this recording, fairly overvalued, maybe a little bit overvalued, but baby, if you want quality, sometimes you have to pay up for quality, because while you're waiting for a deal, so is everybody. And if you want to buy something cheap, well, somebody's got to sell it cheap. So my question is, who's selling Realty Income on the cheap? And last but not least, of course, is Johnson & Johnson, which was incorporated in 1887, and they research, develop, manufacture, and sell products in the healthcare field. Now, they have 3 business segments: consumer health, pharmaceutical, and medical devices. And at the recording of this video, they intend to split off consumer health into its own entity between May and November of 2023. Now, they also spun off LTL, which was created in Texas to hold Johnson & Johnson's cosmetic talc liability in a strategy that's commonly referred to as a divisive merger, or what I love this name even better, the Texas two-step, because it allows companies that are economically viable, like Johnson & Johnson, to create a subsidiary in Texas and divide the company, transferring any liabilities to that new entity. So in this instance, the former parent, Johnson & Johnson Consumer Inc., was divided into a new entity, and all the assets went to JJCI, and all the talc liabilities went to LTL, which they immediately filed for Chapter 11 bankruptcy. But don't worry, J&J stated it will provide sufficient funds to LTL to cover amounts the company owes, as well as create a $2 billion trust to pay claims against LTL, and it will also dedicate the spin-off royalty revenue, estimated to be more than $350 million, to LTL. You may not like it, and it may not be ethical, but it is legal, And I think this could finally start to bring closure to this whole talcum powder debacle. So back to consumer health, it is not a core business, and we can see that it makes up about 17% of revenue. So the consumer health segment is very different from the other two because it's just basic stuff, where the other two segments are trying to cure diseases, which is really exciting. And many times investors would prefer to invest in something that is slow growing and safe, or has a lot of upside growth trajectory, or it is a little bit riskier. So we've talked on the channel about the splits and spin-offs that are happening with companies, and activist investors are obviously pressuring companies to separate the more conservative, slow-growing businesses from the high upside, high growth, exciting potential segments of their business. So when they spin it off, it's streamlining, and it's not crazy that the individual businesses could have more value separately than lumped together into one business with a mix again of conservative and not risky with really exciting growth and risk. So when they do that, they break them apart, and then investors and management can focus on those companies, growing them. And that is why they call it unlocking value when they spin off segments of a business. Something else I love about J&J is that they have 61 manufacturing facilities around the world. In 2020, their top consumer health sales were driven by the over-the-counter products such as Tylenol and Zyrtec. Their top pharmaceuticals were Crohn's disease treatment Stelara, which does have a patent exclusivity expiration coming up, and cancer treatment drugs Darzalex and Imbruvica. And the top medical devices segment revenue is driven by general surgery, which, as it says, is products for surgeons. And check this out, Johnson & Johnson spent less research and development money from 2019 to 2020 on consumer health, but they increased the pharmaceutical and medical devices. Medical devices is higher because of the robotics and digital programs they need to develop. So it's very clear that the consumer health segment is not a core business, and it's pretty different from the pharmaceutical and medical devices. So it just makes sense to break it apart and spin it off into its own entity. Now in 2015, if you put $100 into Johnson & Johnson, 5 years later it would be worth $175.32, as opposed to the S&P 500 index at $202.96. So why buy Johnson & Johnson, which, by the way, is included in that S&P 500 index? Well, check this out. As dividend growth investors, we want passive income and increasing yields. This IBD article from May of 2021 shows that the S&P 500 yield dropped from 1.97% to 1.4% 5 years later, which is not pacing inflation. And as dividend growth investors, we don't want to have to sell our shares. We think of them as buying a stream of income, almost like a sunk cost. Like when I buy a share of Johnson & Johnson, I view that as my money's gone. I can't get it back. Obviously I could, but just for the exercise, I view it as I can't get the money back. All I'm left with is that stream of passive income that I can hopefully pass those shares off onto my grandchildren or my children one day, but use the money to pay bills and live off of, and know that that money is solid and will be growing, where the S&P 500, as you can see, has been reducing and dwindling over the last few years. And Johnson & Johnson's dividend has not been dwindling. They have increased that dividend for 59 consecutive years, almost 7%, 5% raise each year, up and to the right, just like all the other companies we've talked about. Payout ratio of only 60%, very healthy dividend coverage ratio. $4.24 is the current annual dividend payout, which is good for $1.06 every quarter. And a current 2.60% yield. The 10-year growth rate, 6.6%. So I like that. That is obviously pacing inflation. And they're close to some of their peers, with Merck at 3.22% and Pfizer at 3.07%. Their earnings have basically been flat the last few years, with, like most companies, a drop in 2020, negative 0.3% annualized 5-year growth rate. Revenue basically flat, but expected to increase about 14% 3.3% annualized 5-year growth rate, and the cash flow again been basically flat with a 5-year growth rate of only 2.5% for Johnson & Johnson. Now, as with many pharmaceutical companies, we have to keep an eye on the patent cliffs, which obviously are the driver of some of J&J's revenue. Now, one of those is that aforementioned Stelara, which will expire in the United States in September of 2023 and in Europe in January of 2024. But I think this split is going to unlock value for both companies. I think it's a good thing. And obviously, us as investors, the market is going to determine the value of both of those entities. So that will remain to be seen. And we as shareholders will receive shares of both entities in both companies. And I'm hoping that this talcum powder lawsuit can be resolved and settled once and for all. It can be put behind us and management can focus on growing the company and moving forward. I'm still buying Johnson & Johnson. I think that, again, you have to pay up for quality, and they are probably about fairly valued. Now, they are my number one favorite dividend company, followed closely by probably Pepsi and Realty Income. It's, they're like children. How can you pick a favorite? But if you have to, I would go with Johnson & Johnson. But obviously there's issues on the horizon that are going to need to be addressed. So what did you think of this? What companies are you buying? What companies would you like to buy? If you'd like to see what I have in this bridge portfolio that I have up on the board and I update with every video, click the link down to degrin.com, the bridge portfolio. You can check it out there. I do update it when I buy. And we talked about the Realty Income and VEREIT merger. So if you'd like to learn a little bit more about that, click the video right here and I will see you there.